Okay, so if rates are at or near peak, then how soon before we start seeing cuts in the United States?
So I think we are high for longer, not higher. We are high for longer. I've said this many times, I'll say it again. The Fed was very late to the game. The Fed was in this very strong view that we were having, quote unquote, transitory inflation. Their view of transitory was that, yes, all this money we put into consumers, it was all being spent day one. It was not a sustainable consumption path. And B, the supply chain for things they wanted to buy was still not working properly. So once the supply chain got straightened out, the prices of goods would come down. I never believed it was transitory. You just had to look at how much money was in bank accounts, and it wasn't transitory. So I now do think that the Fed has realized it's not transitory. It's sustainable. The consumptive power exists. The Fed, once they realized they had to raise rates, they started slowly but moved very quickly. They went from 25 basis point moves to 75 basis point moves relatively quickly. They got ourselves the 5% plus Fed fund rates. And we're at a point now where, whether it's the Fed's activity or the renormalization of spending or the wearing down of savings accounts, it's all working together that we're sort of the end of this trend. Because the Fed was late, they don't want to be early to leave. When you're the last one to come to the party, you have to be the last one to leave the party. So the Fed is going to be the last one to leave this party. The economy will clearly turn down before the Fed starts to cut interest rates. So I strongly believe that for the first half of 24, we will see no rate activity in the Fed. Maybe Q3 we'll start hearing rumblings of some forward guidance of lower rates. So I think for the next basic 6 months, we're going to be at these rate levels, even though the market has already started to price in softer rates. We've seen U.S. 10-year Treasuries go from over 5% back to below 4.5%.
Absolutely fascinating. And Fed funds futures, to your point, are pricing in about 100 basis points of cuts through 24 already.
Exactly.
Are markets getting it right?
I think markets are probably more or less right, but markets tend to overreact and tend to react faster than the Fed's going to react. So I think in direction, the markets have it right. In speed, the markets probably are ahead of the actual speed of where we're going. We've had an inverted yield curve almost the whole time. And there were many, many people that got on your network and every other network and said that is the precursor to a recession. There were many people like myself that got on and says it's an inverted yield curve. It has nothing to do with the recession. And so that recession never came. So I don't want to overly emphasize what the market is telling you. But on the other hand, I do think that the market is saying the Fed is at their high water mark for rates. The consumer continuously spending. We see consumer debt numbers going up and hitting all new record highs here. We're over $1 trillion of consumer debt in the United States right now. The consumer is normalizing. We're at what I call the economy right now is we're back to a normal. But we all forgot what normal is, because we haven't seen normal for over 2 decades. We went through a decade plus of zero interest rates. We went through a decade of quantitative easing, zero interest rates, and the Fed doing what? Trying to see if they could create inflation. There was, if you would have read the newspapers 5 years ago, and it would have been an article about the Fed, the article would have started like this: will the Fed ever be able to create inflation? The Fed's been at zero interest rates. They've been buying mortgage backs. They've been buying Treasury securities. No matter what they do, no matter how big their balance sheet gets, it seems like we cannot create inflation. So we've gone from the Fed not being able to create inflation. We now know the answer. The Fed can't create inflation, but the market can. To us trying to unwind a shorter-term inflationary shock. We're back into a normal world. So the 100-year average for 10-year Treasuries is about 4.5%. average inflation, we're running back towards the mean to 2.5%. So every piece of economic data, if you look, is sort of heading back towards its very long-term average. If you look at these over 100-year generational cycles, we seem to be running into that phase right now.